The UK housing market just did something strange. Prices didn't crash. They didn't collapse. They split, one half rising, one half falling. And the part that's falling? It's the part that usually leads everything else. Let me show you what I mean. In the latest official UK House Price Index for November 2025, the UK as a whole is back in positive territory, up about 2.5% year-on-year. Sounds good, right? Recovery mode. Headlines are happy. Estate agents are optimistic. But wait. London is still negative. Down around 1% year-on-year. While the rest of the country rises, London is falling. And inside London? It gets even stranger. The Financial Times points to inner London falling far faster. Roughly 4 to 5% down year-on-year. With some of the most expensive boroughs seeing the steepest drops. The places where prices were highest. The places where confidence was strongest. The places that usually lead the market. Those places are now leading the decline. On paper, that looks like one market rising and another market slipping. Two different stories. Two different headlines. In reality, it's a warning sign. Because two-speed housing markets don't just happen. They usually appear when the math stops working for one group first. When confidence cracks in one place. When hesitation starts somewhere specific. And then spreads. Now, I know what you might be thinking. London's always been expensive. Maybe it's just correcting. Maybe this is healthy. Maybe it's got nothing to do with me. And if you're outside London, I get it. Why should you care if some mansion in Kensington dropped a few $100,000? But here's the thing. Prime markets usually turn before the rest. Not because the people who live there are weaker. Not because they can't afford it. But because those purchases are more discretionary. When you're buying a £2 million flat in central London, you don't have to buy. You choose to buy. It's not urgent. It's not necessary. It's optional. And optional decisions are the first to disappear when confidence gets shaky. So when the top end pauses, when the luxury market hesitates, when the discretionary buyers step back, that's not just a rich people problem. That's a signal. A signal about where confidence actually sits. A signal about where the cracks appear first. A signal that usually travels downward through the market. Not always. Not guaranteed. But often enough to pay attention. But here's what's really happening underneath the numbers. Because the UK average rising while London falls? That's not random. It's a pattern. And it tells you exactly who's struggling right now. Let me explain something that most people get wrong. When headlines say UK house prices are rising, most people imagine the entire country moving together. Like one big machine. All gears turning the same direction. All areas rising at the same pace. That's not how housing works. Not even close. The UK average can rise. Because parts of the country remain supported. Lower price points. Different buyer profiles. Different affordability ceilings. In the north, the Midlands, parts of Wales and Scotland. Prices are more manageable. Deposits are smaller. Monthly payments are less brutal. So those markets can still function. Buyers can still make the numbers work. Transactions can still happen. And when you average those areas together with London, you get a number that looks positive. But that number hides the split. It smooths out the reality. It creates a headline that doesn't match what's happening on the ground. Because London, especially inner London, is a completely different machine. Let's talk about what makes London different. It's higher ticket sizes. A normal, family home in Zone 2 can easily cost £1 million. Sometimes more. It's bigger deposits. Even 10% on £1 million is £100,000. 20% is £200,000. That's not savings. That's generational wealth. Or years of grinding. Or the bank of mum and dad. It's often more international. Buyers from abroad. Different currency considerations. Different political sensitivities. Different risk calculations. And here's the key part. When borrowing costs stay elevated, even after rate cuts, the absolute monthly payment in London is still brutal. Let me put that in real terms. If you borrow £800,000 at 4.5% over 25 years, your monthly payment is somewhere around £4,400. £4,400. Every month. Just for the mortgage. Before council tax. Before bills. Before life. Now, yes, someone buying at that level probably earns well. But even high earners have limits. Even high earners do the maths. Even high earners look at that number and think, is this really worth it right now? And when enough people ask that question, the market doesn't crash. It pauses. It hesitates. It goes quiet. And this is exactly what we're seeing in the data. Specifically in one borough. And the numbers are genuinely shocking. Let me show you something specific. Kensington and Chelsea. One of the most expensive boroughs in London. One of the most expensive places in the entire country. The ONS-linked local data shows mortgage buyer prices around £1.2 million in November 2025, compared with roughly £1.44 million a year earlier. On a revised basis. That's not a tiny fluctuation. That's not noise. That's not a rounding error. That's a meaningful repricing at the top. Nearly £250,000. Gone. In 1 year. Now, I'm not saying every property in Kensington dropped. I'm not saying every seller lost money. But the direction of travel is clear. In the segments where confidence used to be strongest, prices are falling fastest. And that's a signal. Not everywhere. Not in every segment. But in the segment that usually leads. The discretionary segment. The I could buy anywhere in the world segment. The I'm choosing London because I believe in London segment. That segment is wobbling. And when the top wobbles, the rest of the market feels it eventually. This is where the situation quietly shifts. Let's talk about what's happening inside buyers' heads. Because that's where markets are actually made. In a normal market, buyers negotiate, but they still believe. They believe prices will rise over time. They believe buying now is better than waiting. They believe the future will reward them. So they stretch. They push their budget. They take the risk. But in a split market, buyers do something else. They wait. They don't panic. They don't disappear entirely. They just stop moving. And the reason isn't complicated. If you're looking at a high-value London purchase, you're not just buying a home. You're buying a long-term financial position. £1 million bet. Maybe 2 million. Maybe more. And right now, that position has too many unknowns. Interest rates have come down from the peak, yes. The Bank of England cut bank rate to 3.75% in December 2025. But buyers aren't only reacting to today's rate. They're reacting to what they think rates might do next. One inflation surprise. One change in expectations. One shift in market pricing. And the whole affordability calculation changes again. So buyers do what rational people do in uncertainty. They delay. They watch the next data release. They wait for a better deal. They see what happens with taxes. And when enough buyers do that at the same time, something subtle appears. And this is where prices start falling, but not in the way you'd expect. Because it's not a crash. It's something quieter. And harder to see until it's already happened. Here's how prices actually fall in a market like this. Not loudly. Not dramatically. Not with headlines screaming about collapse. Quietly. Through longer selling times. A property that would have sold in 2 weeks now takes 8. Then 12. Then the agent calls with feedback. Through reductions. The price reduced tag appears on Rightmove. Then another reduction. Then another. Each one a small admission that the original price didn't work. Through the best homes taking longer to find the right bid. Even the beautiful properties. Even the renovated ones. Even the ones with gardens and parking. They sit. They wait. They don't get the bidding wars they used to get. Through sellers accepting less. Not because they are desperate. Not because they are in crisis. But because demand isn't competing anymore. When 5 buyers want your property, you can push the price. When 1 buyer is considering it, you take what you can get. That's the quiet softening. That's how a market turns. Not with a bang. With a whisper. With sellers gradually realizing the number in their head isn't the number in buyers' heads. And adjusting. Slowly. Reluctantly. But eventually. Now there's another pressure here. And this one is quieter still. Because it's not even lived yet. In late November 2025, the government published details of something called a high-value council tax surcharge. A policy aimed at homes above £2 million. Starting in April 2028. Now, that's years away. 2028. Ages off. Why should it matter now? But here's what people don't understand about housing. Housing doesn't wait for policies to arrive. Housing often prices expectations in advance. Especially in markets where purchases are optional. Especially where buyers can choose between London, New York, Dubai, Singapore, or no purchase at all. So the real question isn't, will this surcharge happen tomorrow? The question is simpler. Does it change how people feel about owning high-value London property? Does it add another layer of hesitation? Does it make buyers want a bigger discount as protection? Even if the policy impact ends up smaller than feared. The uncertainty itself can be enough to slow the market. Because the top end is sensitive to confidence. And confidence is sensitive to policy narratives. One headline about mansion taxes. One rumor about wealth levies. One proposal that might never happen. And suddenly, buyers are asking for 5% off. Then 10%. Then, let's wait and see. That's how policy expectations work. Not through implementation. Through anticipation. But there's another pressure building in the background. And this one affects everyone, not just the wealthy. It's the refinancing wave. And the numbers are starting to show. This is where the system starts to strain. Even when the headlines look fine. The Bank of England's money and credit data for November 2025 showed something interesting. Mortgage approvals for house purchase, around 64,500. Slightly down month on month. But remortgaging approvals were rising. That tells you something important. There are a lot of households actively dealing with resets right now. Not because they want to. Because they have to. Their fixed rate ended. The letter arrived. The new payment is higher. And they need to do something about it. Now, this is the part that gets misunderstood. A mortgage reset isn't a dramatic event. There's no camera crew. No breaking news. It's paperwork. It's a letter. It's a new monthly payment. It's a spreadsheet. But at scale, resets change the market. Think about what happens when thousands of households reset at once. Their monthly payment goes up. Maybe by £300. Maybe by £500. Maybe more. Suddenly, the budget is different. The holiday gets cancelled. The car upgrade gets postponed. The kitchen renovation becomes maybe next year. And the idea of moving house? Of taking on an even bigger mortgage? That becomes a lot less appealing. So resets change what people can afford. They change what people feel comfortable paying. They change whether someone becomes a buyer or stays a renter. And they change how much risk banks are carrying in high loan sizes. Now, here's the important context. Official commentary from the Bank of England suggests arrears remain low. Compared to the GFC. Compared to the early 1990s. This is important. It means we're not describing mass default. We're not describing repossession waves. We're not describing 2008. We're describing pressure. A slow adjustment. A system that is still functioning, but with more friction. And friction is what slows markets down. Not dramatically. Gradually. Through more careful buyers. Through more hesitant sellers. Through transactions that take longer. Through chains that collapse more often. The machine keeps running. But it runs slower. Stickier. With more creaking. So what does all of this actually mean? Because when a market splits like this, something dangerous starts to happen. And it's not about prices. Here's the dangerous part. Once a market becomes two-speed, people start telling themselves stories. Sellers tell themselves one thing. The market will bounce back. I just need to wait. My home is worth what I think it's worth. Buyers tell themselves something else. The market will drop further. I should wait for a better deal. Why rush when prices are falling? And when those two stories harden. When sellers won't budge and buyers won't move. Transactions fall. Not because prices are impossible. Because agreement becomes impossible. Sellers want 2022 prices. Buyers want 2026 discounts. And nobody meets in the middle. This is why split markets matter. They create a gap. A gap between what sellers want and what buyers believe. And that gap is where liquidity disappears. You don't need panic to freeze a market. You don't need mass unemployment. You don't need a banking crisis. You just need enough people to think. Not yet. And the prime London signal is that not yet is spreading. Quietly. Under the surface. Even while national figures look stable. The UK average is rising. But London is falling. Inner London is falling faster. Prime boroughs are falling fastest. That's not random. That's a pattern. A pattern that starts at the top and works its way down. So what are we looking at? Is it an early warning? Or active stress? Right now, it's active stress in a specific place. Prime inner London. The discretionary market. The confidence-driven segment. With a wider warning embedded inside it. Because the UK housing market is not one machine. It's a series of connected gears. If the gear that usually leads, the discretionary, high-value, confidence-driven gear, is slipping, you pay attention. Not with hype. Not with panic. Not with predictions of doom. With discipline. With data. With an understanding that markets can change direction. Long before the public narrative does. So let me give you the honest conclusion. Because this isn't the end of the story. But it might be the moment everything quietly changed. Let me bring this all together. The UK housing market has split. The national average is rising. About 2.5% year on year. Headlines are positive. Optimism is returning. But London is falling. Down around 1%. Inner London is falling faster. Down 4 to 5%. And the most expensive boroughs, places like Kensington and Chelsea, are seeing the steepest drops. That's not a coincidence. That's a pattern. The discretionary market is pausing. The confidence-driven buyers are hesitating. The "I could buy anywhere" segment is saying, not London, not now. And that hesitation creates ripples. Longer selling times. More reductions. Quieter viewings. Sellers accepting less. At the same time, mortgage resets are hitting households across the country. Remortgaging is rising. Purchase approvals are soft. And policy uncertainty is adding another layer of hesitation. This isn't a crash. Let's be clear about that. But it isn't a recovery either. It's a split. A two-speed market. Where some parts are moving. And other parts are stuck. And the stuck parts are usually the ones that lead. So what should you watch from here? First, whether London's decline stabilizes or accelerates. Does inner London find a floor? Or does the drop continue? Second, whether the split spreads. Do other expensive areas start showing the same pattern? Does the southeast follow London's lead? Third, the refinancing data. Are more households struggling with resets? Is the pressure building or easing? Fourth, buyer psychology. Does confidence return? Or does "wait and see" become the default behavior? Because markets don't crash suddenly. They change direction gradually. And the change often starts in the places nobody's watching. If you're watching from the UK, I'd genuinely like to hear what you're seeing. Are properties sitting longer in your area? Are you seeing more price reductions? Are buyers still competing? Or has everything gone quiet? If you're in London specifically, what's the mood on the ground? Are sellers realistic? Are buyers waiting? Drop a comment. Share what you're seeing. Calmly. With real observations. Because the national data only tells part of the story. Your local experience fills in the gaps. Subscribe if you want more measured breakdowns. No hype. No doom. Just what's actually happening beneath the headlines. This isn't the end of the UK housing story. But it may be the moment people realize. The market has already changed. Not with a crash. With a split. And splits. Splits are how the quiet changes begin. See you in the next one.